Welcome to Financial Issues, where we join reality with truth, helping you make the most of your money by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
Good morning. Welcome to Financial Issues. Thanks for tuning in today. I'm your host, Shana. Today's Rapid Fire Friday. So if you've got questions, get your call queued up now. The phone number is 610-363-1110. You have tuned in to Financial Issues, and we are a ministry that helps to educate people about financial issues from a biblical worldview. We hope that you are a partner with us. If you are not, you can become one for just $132 a year. You'll get access to your own biblically responsible investment strategy. We give you a very practical way to honor God in the way that you invest. And if you continue to listen to the program, you will be continued to be encouraged to be a joyful, generous, and obedient giver. We call that funding the light. So using the resources that we've been trusted by God to manage to serve and honor God in everything that we do. So on today's show, we will get to your questions and calls. The phone lines are open, 610-363-1110. You will be the first caller in the queue today. We're going to get you caught up, or try to anyway. I said I have to quit looking. Things are happening so fast. So we'll get you caught up to at least what's happened up to the beginning of the show today. We'll get you in the know, and we'll get encouragement from the scriptures. We'll be in Revelation 17:14. It feels like we're living in Revelations today. So at Financial Issues, we help you stay in the know about the financial issues of the day. We help keep you abreast of what's happening in the economy and the markets, and help you understand how that impacts or doesn't impact your own personal financial issues. So focus in on some key takeaways that I have from this week that is ending June 27th, 2025. Earlier this week, we got a manufacturing report. According to the June S&P Global PMI report, I've got a couple of quotes directly from that report. They said that price pressures rose sharply across both manufacturing and service sectors during June, the former reporting an especially steep increase, and again commonly linked to tariffs. They went on to say that input prices and selling prices both rose at rates not seen since July of 2022, as higher costs were passed on to customers. They said close to 2/3 of all manufacturers surveyed were reporting higher input costs attributed to the tariffs, while just over half of the respondents linked increases selling prices to tariffs. So some say they are, some say they aren't. This sort of supports the idea, at least, that some of the tariffs will make their way to the consumer, but it is still expected by many to be a one-time phenomenon. We saw that with even with the Fed's summary of economic projections that they updated just last week. In housing news, I pulled out two quotes from two home builders that are on our broad list anyway. So KB Earnings said, as to market conditions, while longer term, the outlook for the housing market remains favorable, driven by demographics and undersupply of homes, consumers are still continuing to demonstrate a lack of confidence about the short term, which has impacted their home purchase decisions. Affordability challenges have persisted, compounded by the variability in mortgage interest rates, which remain elevated, as well as macroeconomic and geopolitical uncertainties. These factors resulted in more subdued demand during the spring selling season. As a result of this softer environment, we are revising our guidance for fiscal 2025. So one home builder saying that things are still tough, and they're revising their guidance down for 2025. Lennar said on their earnings call, they talked about the home building industry remaining very challenged with higher mortgage rates and lower consumer confidence about global and domestic circumstances still being uncertain. They said this, quote, across the housing landscape, actionable demand has been diminished by both affordability and consumer confidence, and therefore has continued to soften. So we do like home builders. No, we don't have any of them on our buy list right now, but there are several that are still on our broad list, and many that our partners have done very well in, even though they're down a little bit from their highs. So it may still be a little bit early to move back into the home buyers, but if you're a long-term investor, I agree with what KB said, that the long-term outlook for the housing market looks good. As soon as either people can digest these higher mortgage rates or mortgage rates come down, which would be the preferable scenario. On the Fed front, Michelle Bowman joins Waller in the cut soon camp. Michelle Bowman came out on Monday and she said this: should inflation pressures remain contained, I would support lowering the policy rate as soon as our next meeting, which is in July, in order to bring it closer to its neutral setting and to sustain a healthy labor market. So we have two Fed governors who have spoken up for rate cuts starting pretty soon, and one other one that is almost there. The market has now fully priced in two interest rate cuts before year end. What is interesting to me is that Powell has had the lowest dissent rates of the most recent 5 Fed chairs. His dissent rate is right at 2.5%, but it seems to be rising, versus a 6.5% average rate for the other 4. Or for all 5 of them, the average rate is 6.5%. So Kashkari this morning also is one of the Fed governors, and he came out this morning and gave an indication that he is still in the later to cut camp, indicating that he doesn't think that a cut is imminent until September. He said the jury is, well, he didn't say, I'm summarizing here. He said that the jury was still out for him on the impact of tariffs, and that monetary policy should focus on the real impact, meaning that he thinks that they need to wait to act until they see what damage has already been done. He thinks that tariff effects could just now be starting to show up. Speaking of inflation, PCE came out this morning. Now, PCE follows the CPI and PPI data that we got earlier in the month, and it typically is not really any surprise. So, headline PCE, which is the core, which is the Fed's preferred measure of inflation. Both of them came out this morning. The headline was expected to be 2.2% and core 2.6%. Both of those numbers came in a tad bit hotter than what was expected. The core PCE rate for May of 2025 was expected to have increased 0.1% month over month to an annual rate of 2.6 versus 2.5% in April, but it actually came in at 2.7%. So just a little bit hotter than expected. Headline PCE, which does include food and energy, was expected to come in at 2.2, and it came in a little bit hotter at 2.3. Let's back up for just a minute and look at the trend for 2025, though, as we shift from Bidenomics to Trumponomics. We're down to 2.7% from 2.9 at the beginning of the year. We had gotten down to 2.5, but we're back up to 2.7. Headline PCE is down 12%. Core inflation is down 7% from where it was when Trump first took office, with core still remaining a little bit sticky, but the trend is looking like it is coming down more. I think it's no coincidence, though, that government spending is down. If inflation is going to trend down, government spending is going to have to trend down. According to the Bureau of Economic Analysis, real government spending has decreased in the first quarter of 2025, contributing to the annualized GDP contraction that we did see. The BEA notes that the drop in government outlays as a key factor in this. So it's crazy that we count government spending in GDP, but we do. The Commerce Department further reported that federal spending fell by 4.6% for the first quarter. That gets a big hand clap for me and encouragement to keep going in that direction. Jobless claims for this week. The 4-week moving average continues to move up. That's what I keyed in on when I looked at the unemployment numbers for the week. Since January 4th, the 4-week moving average has trended up by 15%. More on that in just a minute, though. My clock is lagging. I just got the 1-minute warning, so I'm not going to finish this segment, but I'll get through as much as I can, and then we'll pick up again. Personal income and personal spending did get reported this morning just before the show. The bulk of the news came right before the show this morning. So personal income was negative for the first time since September of 2024. It came in negative 0.4%. We were looking for an increase of 0.3 to 0.4%. Personal spending came in down 0.1%, while we were expecting an increase of 0.1%. We got to take a break, folks, but stay tuned. We're going to be back. We'll get the rest of the data. We'll get you caught up and in the know. Stay tuned. I'm your host, Shana.
There are moments in life that define us. Choices determine the courses we take. Choices that create life, save a life, and some make life worthwhile. There are decisions to stay or to go, to remain the same or to grow. Sometimes we pray and make peace. Other times we take a stand for what we believe. In celebration, mourning, triumph, and defeat, we are invested in every decision we seek. Despite differences, we have one thing in common: the desire to do all for the glory of God. Keep your wallet aligned with your heart and your investments in harmony with your faith. Timothy Plan, biblically responsible mutual funds, ETFs, and retirement plans. Before investing, carefully consider a fund's investment objective, risks, charges, and expenses contained in the prospectus available at timothyplan.com. Read carefully before investing.
Through Crossroads Kids Club, lives like Dali's are being changed all over the world.
When I was 8 years old, my parents separated temporarily. It made me feel lost, empty, and without direction. Until one day, I went with my cousins to the Crossroads Club. This led me to know Lord Jesus and accept Him in my heart. He changed my life, and I don't feel lonely anymore.
Reaching kids with the hope of the gospel in schools and across the world. You can change a young life today at reachOurschools.com.
If a woman sees her baby on ultrasound, it doubles the likelihood that she'll choose life. And on top of that, we share the gospel of Jesus Christ with her. This is why you should support preborn. The donations that you give actually make a difference. Last year, 59,000 babies were saved because of what you have done with your generosity.
To find out how you can support the life-saving mission of preborn, go to preborn.com/FISM.
Securities offered through G.A. Reppel & Company, a registered broker-dealer and investment advisor, member FINRA and SIPC. Opinions expressed by Shana are hers alone and are for informational purposes only, and do not necessarily represent those of G.A. Reppel or the outlet on which you are listening. You should consider how the information applies to prior to personally implementing it, and consult any financial professional you work with to make sure it's applicable to your financial plan.
Welcome back to Financial Issues. Thanks for sticking with us this morning. It seems like I'm having internet issues over here, so my technology is lagging just a little bit. So I'm glad to have such great support there in the studio all the way in Pennsylvania. So they're keeping me on track. All right, let me pick up here. So we're talking about personal income, personal spending, real spending. We got those numbers out just before the market started. Just before the show started. The market is not open yet. just before the show started this morning. So personal income came in negative for the first time. It came in down 0.4 of a point. We were looking for it to be up 3 to 4 of a point. Personal spending was also down, which makes sense. If your income is down, people tend to cut their spending as well. So down 1/10 of a point while we were expecting an increase of 1/10 of a point. Real spending was down 0.3 of a point, and we were expecting unchanged. So this could indicate that weakening in the consumer that has been telegraphed for so long. We keep hearing, the consumer is weakening, the consumer is weakening, the consumer is weakening by all of the survey, the official numbers. But then when we hear the unofficial numbers, the surveys done and the data collected by those who actually have their finger on the pulse of the money, the banks, and the credit card companies that can actually look at the real data from spending, they say, no, well, the consumer is still pretty strong. So this for me is not yet a trend. I think a lot hinges on that one big, beautiful bill that we're supposed to get by July 4th. That's becoming more and more questionable in my mind, whether or not that will actually come to fruition, at least by the July 4th deadline. So the consumer is shifting to replenish their savings, as I heard it called in a report just this morning, revenge savings. After COVID happened and, the Americans got all of that COVID stimulus into their bank accounts but couldn't really go out and spend it. Once things opened back up, they started spending like crazy, mostly on services. They replaced their TVs and computers and furniture and things at their house while they were cooped up in their house. But once the economy reopened, there was that revenge spend on things like travel and vacations and out to eat and all the things that you couldn't do when you were cooped up in your house. Now, it seems like the shift is changing to replenishing savings. Now, that's a revenge kind of trend that I could get behind, building up there, especially when it comes to their emergency savings. So I didn't catch the personal savings number for this month. There was too much of a data dump right before the show, but I was looking at the trend before the number this morning, and the income, which the personal savings rate is the income that you have left after you spend what you're going to spend and pay your taxes. So the savings rate prior to May, so I have the number for April, went from 3.5% in December to 4.9% in April. That's a good thing. A study or a survey done by Vanguard showed that 71% of those that they surveyed are focused on increasing their emergency savings. That's something that we talk quite a bit about here at Financial Issues, especially that's something that you definitely want to do and have in place before you even start with investing, because you don't want to have to sell things in the short term to meet that you had bought for the long term to meet your short term needs. So there was also an increase in savings that people are doing in their employer plans, like in their 401k plans. At the end of 2024, participants were saving about 8% of their salary. That increased in the first quarter of 2025 to 9.5%. So, I think some of this can be attributed to the fact that 401k companies have started instituting auto enrollment and auto escalation plans in their 401ks. So when you go to work for a company, a lot of times, especially if you're in one of those big 401k plans, you're auto enrolled when you get on the payroll, and ever so often every year your contributions are increased. So a lot of times you start at 5% and then they increase you by 1%. Now that doesn't mean that you're stuck doing that, of course. It just means that the default is that you are enrolled already as a participant and increasing your contributions, and you have to tell them that you don't want to, versus how it used to be, where whenever you come in, you're told when you can qualify to start the savings plan or to get enrolled in the 401k plan, but you have to proactively do that. So they're saying that is one of the reasons that savings is increasing in 401ks. Now, what is the recommended rate? Well, according to this same survey that I heard, one of the big 401k providers is 15% is what is recommended as a savings rate. I'll just elaborate on that a little bit, and I'll say it really depends on when you start. If you wait to start saving, the longer that you wait, the more you have to save to get to the same end goal. The markets since last Friday are flirting with all-time highs and are indicating that the market's going to open and continue going in that same direction. So since the beginning of the week this week, or since the close of the market last week, the Dow is up 2.74% for the week, the S&P 2.83%, and the NASDAQ up a little over 3.5%. And again, the pre-markets are indicating a slight positive open this week. So I get you caught up on this past week. What's coming next week? Well, it is a short week because of the July 4th holiday on Friday. So we will have our Rapid Fire Friday next week on Thursday. And in preparation for that long weekend, we'll also get the jobs numbers that come out next week. That always happens in the first week of the month. So the experts are currently expecting an increase of 129,000 jobs for June. Now, this is a little bit below May's actual gain of 139,000, which exceeded the outlook of 130,000 for that month. So the implications of the report will sway Fed policy more than President Trump's post on Truth Social. So, you've had the president calling on Jay Powell, calling him a lot of names, but calling him really too late on cutting rates, calling for him to cut rates. And Fed Chair Powell has sort of dug his heels in and held off on those rate cuts. So the Fed's two mandates are for full employment and for price stability. So Powell's, depending on what the jobs reports say next week, this may give Powell more cover. If the jobs, the labor market looks like it's weakening even more, then Powell will say that he's justified in waiting. I think the most interesting scenario would be that if the labor market holds steady and stays strong like it is described to be right now, that Powell will have no data to cover his policy for keeping rates steady, which would likely make him even more late to the game than he already is. So now that you're in the know about the recent and upcoming financial issues, we hope that you'll learn more about how we can help you integrate those issues into your own stewardship. At Financial Issues, we equip you with the tools that you need to defund darkness by becoming a biblically responsible investor, screening out those companies that are using shareholder dollars to fund ungodly agendas. And we encourage you to fund the light through by being a joyful, generous, and obedient giver. If you're not yet, I encourage you to become a partner. You'll get access to all of our asset allocation models that you can use to build your own portfolio. You'll get the weekly buy list and commentary that is available exclusively to our partners, and you'll be invited to attend our monthly partner conference call. So remember, your investments have a purpose. Defund darkness by being a biblically responsible investor. How am I doing on time?
We're okay, Shana. We've got about 2.5 minutes left. I think.
Okay, my clock tells me I've got 6.5. We better jump on it. The stewardship verse of the day today comes from Revelation 17:14. These will make war with the Lamb, and the Lamb will overcome them. For he is the Lord of lords and King of kings, and those who are with him are called, chosen, and faithful. What do you think, Seth?
This is great, Shana. We can be confident that no matter the strength of the earthly powers making war with the Lamb of God, he will overcome them. This is a great promise from the book of Revelation. And, Shana, in a very real sense, Christ has already overcome these powers. He's already won the actual victory with his death and resurrection. There's still some battles to be fought, but the war has been won. And there's just such great joy of being counted among those who are called, chosen, and faithful. It's all by the grace of God. It's wonderful.
Amen. Throughout human history, there have always been two sides, good and evil, and the choice to pick which side we want to be on. We are so bad in our own righteousness that we don't even deserve to be on God's side at all. But it is a great privilege, and with great privilege comes great responsibility. When we realize that all that Jesus has done for us, our right response is a heart of grateful humility, a heart that recognizes that everything is His and is for Him and belongs to Him. And we get the opportunity to exercise great stewardship. We will be greatly blessed when we choose the right side and we devote all that we have to making Him known. So, hope you enjoy our stewardship verses of the day. But if you want to go deeper, make sure that you join Seth in his Bible study on Friday mornings. He did that this morning, as well as every Friday morning. You can find out more information by going to our website, financialissues.org. We hope that you're following along with us on social media. We're on Facebook, YouTube, Rumble, X, Truth Social, and Instagram. So maybe another one, and podcasts. There's so many ways that you can get us, but make sure that you get our phone app, because that's the surefire way to make sure that you always have the program with you. For those of you who are only watching the short program, we wish you a great weekend this weekend. For everyone else, stay tuned. We'll be back with more financial issues.
In the last 10 to 15 years being in ministry, being married, something that has been constant in our lives is Samaritan Ministries. As we've moved, we've had babies, we've had different things come up, we have just been able to rely on Samaritan in ways that we never really even thought about before becoming members.
Our heart's desire is to plant roots and be in a place for a really long time. It's how we were raised. We see the benefits of that, but we also see the open-handedness of being used by the Lord wherever He calls, because we just assumed when we started pursuing church planting, the quickest way to get from point A to point B is a straight line. And with the Lord, sometimes you find out it looks a lot more like this. And yet, Samaritan was with us through the entire thing.
We didn't have to look into, we have to change insurances now because we've moved states or whatever the case may be. And it's just been a real blessing to us in different phases of life.
I'm Kyle.
I'm Colleen.
And we're the Gen X.
And we're Samaritan members.
If you're like me and used to think managing your investments was overwhelming or just for the experts, think again. I used to believe I needed a financial analyst to handle everything, but financial issues showed me I could manage my own investments while staying true to my faith. It's completely transformed how I handle my finances. What felt like a foreign language is now simple. I can buy and sell stocks with confidence, knowing my investments align with my faith. And the best part, this empowering, life-changing guidance is affordable. Just $132 a year. FISM gave me the tools to restructure my portfolio, diversify, and track my investments, all in a God-honoring way. Their video library taught me how to steward what God has entrusted to me with wisdom. If you're ready to gain financial peace and manage your investments with purpose, I can't recommend Financial Issues enough. It's something anyone can do.
To learn more, go to financialissues.org.
Make a point. No matter what happens, I'll always be there for you.
I know.
Welcome back to Financial Issues. Thanks for tuning in today. It is Rapid Fire Friday. As far as I can tell, we don't have any calls in the call queue. Try to set me a little bit of a timer here so I can keep up. Technology is wonderful when it works, but sometimes it just lags.
It betrays us when it doesn't work. It's the worst.
It does.
Especially in this business, right?
I know, right? We get so dependent on it.
Yeah.
So, speaking of technology, you can use the old-fashioned technology, the telephone, if you want to call and get your call queued up today, 610-363-1110. As far as I can tell, you'll be the first caller in the queue today. So, 610-363-1110 is the phone number. We do have a backlog of questions. Why don't we get to some of those?
Good deal, Shana. Let's start with David. David is 55. He's following the fund growth and income model. He says, I have mutual funds in all sectors except commodities. What mutual fund would I invest in to fill this sector? What do you think?
All right. So you have to use ETFs. There's only two things that we have in that commodity sector, and they are both ETFs. But if you can only do mutual funds, which, on any brokerage platform, you should be able to use the ETFs that are mentioned. But if you're only using mutual funds, it would have to be MF59. That is one of the only mutual funds on our list that actually has the capacity to hold some of those commodities that we're talking about. Last time I looked, though, they didn't have a very large exposure to those things. So the best course of action, I think, would be to use the commodities that are listed in the commodity sector.
Great, Shana. Eric is up next here. Eric is 50. He says, Shana, I have a rollover IRA and a Roth IRA. I'm currently contributing to the Roth IRA about $100 per week. I'm not contributing to the rollover IRA. He's got two questions here, Shana. The first one, he says, I'm using the FISM growth and income model to build my portfolio. Can I treat these two IRA accounts as one portfolio? You want to answer that one first?
Yeah. So, yes. And according, to my opinion, you should. So any money that is earmarked for the same purpose. So these two IRAs, most of the time IRAs are used for retirement savings, whether it's a Roth or a traditional. If the money is to be used for retirement for the same purpose, then I would consider it the same portfolio. Now, I like to use a tax-located strategy, which means that, you look at the tax treatment of the two different kinds of accounts that you're talking about, and you take advantage of the tax treatment. So in the Roth account, you're going to have tax-free growth. So I like to use the most aggressive pieces of my portfolio in the Roth IRA. So, the neat thing about our portfolio tracker is that you can put all of your investable assets on the tracker, and you can then view everything as one portfolio altogether, regardless of whether you have them in different accounts, maybe at the same brokerage firm or the same location, or whether you have multiple accounts across multiple platforms. You can put everything on our tracker and be able to look at the big picture.
Awesome, Shannon. Then Eric's follow-up saying, if I can do what he's saying, treat those two IRA accounts as one portfolio, are there certain positions that would be better in the Roth or vice versa? And it sounds like you just answered that a lot, Shannon.
I did.
Yeah. So, that's great.
All right, yeah.
Awesome. Next one, Shanna, is Jackson. So Jackson is 72, and Jackson's saying, what's the difference between fixed income, certificates of deposits, preferred stocks, and cash? I have been under the impression that cash, CDs, and preferred stocks are all under the umbrella of fixed income. Would you please clarify this for me? My efforts to have my investments closely match the portfolio tracker is driving me to distraction. What do you think, Shanna, for Jackson?
Yeah, so I would consider all of those three things that you mentioned, preferred stocks, certificates of deposit, and even sort of cash. And if you're using money market that pays you some interest, I would consider all of that fixed income. Now, the money market cash part is defined as just cash because there's an allocation for cash in each of the the asset allocation models. So the fixed income is a sector, and it includes everything on the fixed income broad list. So if you want to look at everything that's out there, you can look at the broad list. If you want to look at the things that we have on the buy list, that'll show you what you can use to make up your fixed income portfolio if you're building or rebalancing a portfolio. So I think of preferreds as fixed income. So like conceptually, if I'm trying to build a portfolio that is, say, 25% fixed income, 75% in equities, even though a preferred stock is technically an equity, I tend to count it in the fixed income allocation. But we've tried to make it pretty simple. We've even broken out. Preferreds have their own category in our asset allocation model now, so that should kind of clear up. I mean, I guess this is a recent question, but that should really clear up the question of, in the fixed income, if I'm trying to allocate a certain percentage toward fixed income, do I count preferreds or do I not? So technically a preferred stock is an equity, but it works, it looks like, smells like, acts like fixed income.
Great, Shana. That's really helpful. Melinda's up next, 71 years old. Melinda says, I'm trying to rebalance my income model portfolio since the change in it. And I noticed there are two specific stocks. One of them is FP63. The other is F90. She owns FP63. I don't know if she owns F90. I'm not entirely clear on that, Shana, but she says they both seem to be the same company. So I just want to make sure they're both on the buy list and it's not just an error in one of them. And is it okay to buy both if they're able to be bought?
Yep. So it is that you are correct. It is the common stock of a financial company, and it's also the preferred stock of that same financial company. So if you're paying mind to our, rule of thumb that says, don't take more than a 3% stake in an initial stock position, does not apply to mutual funds or ETFs or the commodities. But if you take a 3% stake in each, you still have very minimal exposure when it comes to your overall portfolio. So I think it is just fine to do that.
That's good. And Shana, this is kind of a follow-up for that, but would you, if you have a situation like this, as Melinda has, where she's got the same company, one's a common stock, one's preferred, do you treat those as two separate holdings, even though they're the same company?
Yes.
Okay.
So one of them goes under your preferred sector,
yep,
and the other one goes under, in this case, under her financial sector.
Great. I think we can at least squeeze one more in, Shana, before the ag. Julie is saying, Shana, why is TE1 not on the buy list?
Because there are just so many to choose from. So there's definitely nothing wrong with that company. It has done very well for our partners. There's just there's several in the space. I would say that is one of the top three when you compare it to its peers. So there's certainly nothing wrong with it. It's just what typically happens is if we get too many similar stocks on the list, it sort of freezes up the partners and they start asking, well, which one should I buy? So there's the short answer.
No, that's good. We might be able to squeeze one more in here, Shana, actually. A similar question. It could be close. William is saying, what stocks are candidates for dividend reinvestment?
Okay, so I don't like to choose auto reinvestment on any of the individual stocks. As far as the mutual funds and I guess the ETFs, well, just the mutual funds, you could set up to do reinvestment. But I prefer to make all of my reinvestment decisions, asset allocation decisions, on my own. So when I'm setting up a portfolio, I have all of the dividends for the individual stocks and the ETFs just pay into the money market. And then as that builds up, then you get the opportunity to decide where you want to deploy it to.
Nice.
All right. We got Craig. I still got 4 minutes, though, guys.
Plenty of time, Shana. Let's keep going.
If I keep talking, Craig's going to talk right over me. So here comes Craig. Stay tuned.
This is Craig Haugaard with your Financial Issues Ag update for June 27th. Well, for corn, it's starting to feel like Groundhog Day. Another day, another down move, as we once again saw new life of contract lows. International news was bearish as well, with analysts increasing their estimate of Brazil's second crop corn to 108.5 million metric tons. That's up from 97.3 million a year ago. December corn finished the day a penny and a half lower at $4.21 per bushel. Weather weighed on soybean prices as traders pondered two questions. First, How big will the U.S. soybean crop be? And secondly, is the Brazilian crop even larger than forecast? At this point, the indicators are pointing to a large U.S. crop, and the Brazilian crop appears to be coming in fact, larger than expected. November beans were 2 cents lower at 10.16 and a half. The wheat market reflected the current scenario in which the U.S. weather looks benign for row crops, and U.S. wheat harvest and related hedge pressure continue to bring selling into the market. We also saw world wheat markets weakened yesterday, with Russia's prices dropping by $3 per metric ton. Minneapolis September wheat was 2.5 cents lower at 6.25 and a half. Kansas City dropped by 5.5 cents to close at 5.33 3/4, and Chicago was 7 3/4 cents lower at 5.36 3/4. Cotton futures closed higher for the fourth consecutive session. We had December futures up 48 points for the day, settling at 68.80. Livestock futures were mixed. August live cattle were 22.5 cents higher at $209.20 per hundredweight. August feeder cattle were up an even dollar as they closed out the day at $303.30 per hundred. And August lean hog futures dropped by 97.5 cents, closing out the session at $110.25 per hundredweight. Class 3 milk futures closed up slightly. At the closing bell, we had July futures 9 points stronger as they settle out the day at 17.09. This has been Craig Haugaard with your Financial Issues Ag Update. We'll be right back with more financial issues after this.
It's up to us to stand up and say, enough is enough. All of this unbiblical stuff that's going on, whether it's abortion or transsexual or LGBTQ, widespread pornography, human trafficking. Bottom line, it's still up to us. If we stop investing in these corporations that are trying to destroy us, sooner or later they're going to wake up.
To learn more about biblically responsible mutual funds and ETFs, go to timothyplan.com.
Hi, this is Shana Bird, the host of Financial Issues. Financial Issues family is so blessed to have saved tens of thousands of babies, all thanks to the generous support of you, our listeners and viewers. For $140, you can sponsor 5 ultrasounds. Please go to preborn.org, that's preborn.org, or financialissues.org and click on the Preborn logo. Save a baby, save a life.
Through Crossroads Kids Club, lives like Sarah E's are being changed all over the world.
When I was 8 or 9 years old, I became aware of the kind of family environment that I was living in. My father, thanks to his alcoholism and drug use, ran the home with insults, physical and psychological abuse. And that led me to start harming myself. But when the church started the Crossroads Club, it helped me to draw closer to feeling Christ in my heart again, and to heal. When I was at the Crossroads Club, seeing the volunteers serving God, this truly filled my heart with a lot of joy. I wanted to be like them.
Reaching kids with the hope of the gospel in schools and across the world. You can change a young life today at reachOurSchools.com.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
Welcome back to Financial Issues. It's the home stretch of our Rapid Fire Friday program. I'm your host, Shana Bird. The phone lines are open, 610-363-1110. You will be the next caller in the queue. If you get your call queued up, I'll say in the next 1 to 2 minutes. So if you get your call queued up, we'll get to you, 610-363-1110. While we're waiting, let's do some more questions.
Yeah, good stuff, Shana. Robert has a very similar question to one we answered in the last segment. He's asking, is it okay to reinvest dividends from a stock on the broad list into that same stock? I bought them while on the buy list, but now they've moved to the broad list. I have my account set up to automatically reinvest any dividends back into the stock. He's 61 years old, Shana. What do you think?
Yeah, I mean, it's fine to do that. I much prefer, we answered this question just in the last segment, but I much prefer to make my own reinvestment decisions. So for individual stocks and ETFs, I do not have them coded to automatically reinvest. If you own the positions that are reinvesting in an IRA account, it's totally fine for tax purposes because it doesn't get muddied up. And most brokerages, even if you own it in a taxable account, reinvesting changes your cost basis, not by a lot, because let's say that you initially buy 100 shares and maybe your reinvestment quarterly gets you a few fractional shares. What you'll notice is that the number of shares that you own very, very slowly creeps up, so it increases. Most brokerage firms do a great job of tracking your cost basis for you, and if you have to sell a position later on, they'll send you the average cost basis data that you can then just pass on to your CPA. But if for some reason you don't have that information, reinvesting the dividends does complicate that calculation a little bit. That's not the main reason. The main reason that I don't reinvest the dividends on stocks and ETFs is just, like I said, because I like to get to make those decisions on my own.
That's awesome, Shana. Great stuff. Caroline is up next here. Caroline is saying, I'm using the FISM growth model. She's 33 years old, saying, I'm curious about how to go about diversifying within the commodity category. That's 9% weighting for her. On the buy list, there are only 2 listings. There's MA5, MA55. Am I right to think all funds in this category should be responsibly split between these 2 options? Or should I wait for further options to appear on the buy list for more diversity? What do you think?
So those are the only 2 that we even have our eye on for that sector right now. There's nothing else that we're even considering. So yes, Caroline, you would be right to think that they should be split between those. I tend to like MA5 just a tad bit more than MA55. So if let's just say I had a 9% target, I'd probably do 5 in one, 4 in the other.
Awesome, Shana. Brian up next here. Brian is asking about F45. He's 69 years old. He's saying F45 announced a repurchase. Will they offer a price that is competitive, or should we ignore and whatever will be? And then also, can they force a sale? And what is FISM's view? So actually a couple questions there from Brian. He's 69.
Right.
What do you think?
So it is voluntary. Anytime a company gives like an odd lot offer, like if you own less than 100 shares, they'll offer to buy back your shares. This has been very common practice for companies, as companies have really escalated over the past 5 to 10 years their stock buybacks. So they've been buying up their own shares because they think that is the most efficient use of the capital that they have. So whenever they offer these repurchase agreements, they are voluntary. You do not have to do them. But I mean, at the end of the day, the market decides the price of a stock. So on any stock transaction, you have a bid and an ask. There are 2 parties to the transaction. There's someone who wants to buy a stock for a certain price, and there's someone who wants to sell the stock for the price that somebody wants to buy it for, or vice versa. Somebody wants to buy what the person wants to sell it for. That's a very simple explanation of how the market works. So if a company is offering less than the market price for the company, they're not going to get any takers. It's just as simple as that. So if they don't offer a competitive price, then no one will participate. The only way that they could really force a sale is if they take the company private. So if they say, we're buying back all of our stock, it's not an option, the company's going private. Of course, there's filings with the SEC and all of those kind of things that hoops that they have to jump through. But in this particular case, it's voluntary. It is a company that is still on our buy list, so I wouldn't be interested in selling my back.
Cool, Shana. Audrey's up next here. Audrey's not a partner. I do hope that she'll become one. She's got some good questions here. She says, my husband and I have recently sold a small residence that we owned for the last 4 years under a contract for deed. The agreement is $75,000 down, $2,500 a month for 36 months, and a balloon of $400,000 within 3 years. We have a primary residence as well with a $400,000 mortgage. We're not sure what to do with the proceeds of the sale. We're 61 and 62 years old. We don't have significant investments outside of this CFD. We plan to work to ages 68 to 70, God willing. Could you provide some advice for us, please?
Well, I can't really provide advice per se because I don't know all the ins and outs of your particular situation, but I can give you some things to consider. So, I don't know how close you are, plan to work to ages, so another few years. I think it's a good idea. I like to see retirees go into retirement with no house note. For the most part, everybody's situation is a little bit different. If, let's say that you have a lot of resources saved and you aren't really dependent on those resources, then, you could be more sophisticated in how you approach the use of debt. But I would say for most people, for the average person, it is a good idea to have the mortgage paid off by the time that you get to retirement. So, whether, and it also depends on what other kind of assets you have. I don't know what your income needs are. So, it's really hard to say. But here's the thing that you have to remember in general when you're considering, and I'm trying to read between the lines here and see, what they're asking. If they're asking, should I use this money to pay off the $400,000 mortgage? I also say it depends too. Let's say that you've got a $400,000 mortgage on a $1 million property, and let's say that you plan on downsizing when you retire, maybe moving somewhere else, maybe closer to your kids or whatever that might be. Maybe you've got a big house right now and you don't want to take care of that kind of house whenever you do retire. So maybe you've got enough equity that when you sell your house, you're going to be able to repurchase something just outright and maybe even still have some money left over. So in that case, I wouldn't personally be considering using the money to pay down the mortgage that I have. You also want to look at the interest rate on your current mortgage. If you're like 80 to 90% of people, you have a mortgage rate that's below 5%, and you could even have one that's below 3%. So if I had a 2.75% mortgage right now, there's not many arguments that could convince me to put the money into the house, because money has to have a home at the end of the day. It has to be invested somewhere. So if you're paying off your mortgage, what you're doing is you're investing the money in the house and then into that piece of real estate. So then to be able to have use of the money, you've got to do one of two things. Either you've got to sell the money to be able to have the money to do whatever else it is that you want to do with it, or you have to ask a financial institution if you can put your house up as collateral and then borrow that money. The financial institution is going to want to be convinced, they want to be very confident that you have the ability to pay that money back, because they really don't want to have to repossess the house and sell it and those kind of things. So they really want just for you to pay what you owe. And if you're then in retirement and you don't have a consistent income, let's say maybe you have some Social Security, maybe you have a little pension, but the bulk of your income now comes from your savings, well, that tends to make lenders feel less secure than if it's coming from, let's say, a job or some kind of pension that you can't outlive, or Social Security or something like that. So, if you have a lot less income that you have now, you may not be able to get a loan back from the bank, which then means you only have one of two options, which is either you've got to sell the property to get the use of the money, or you have to do something like a reverse mortgage kind of strategy. So I hope that gives you some things to think about, Audrey, and I hope that you will consider becoming a partner, because we are so grateful. This is a partner and listener supported ministry. So the majority of the money that we get to do the work that we do, which is to research stocks, which is to show up every day on the radio and social media and podcast and our phone app and our partner conference calls. All of that is funded in great part by the people that listen to the program and the partners of the program. So we hope that if you find value, if you're being encouraged and learning things about stewardship, we would encourage you to, in turn, support this ministry. You can find out more about our ministry at financialissues.org. This is it for us today. We hope that you have a great day of worship on Sunday. We hope that you come back next week because, Lord willing, we will be here and we will be reminding you that time is getting short. The Master's coming back, and we want to help you be found a good and faithful steward with all of the time, talent, and treasure that the Lord has trusted you to manage. Go check us out at financialissues.org and come back next week. We'll see you later. I'm your host, Shana Burke.
If we ever forget that we're one nation under God, then we will be a nation gone under.
Thank you for joining us. This has been an FISM production.